comfortable with their domestic equity and bond portfolios because they tend to thrive during periods of economic growth and low inflation. And we don't blame you. It's been a great ride. But it's a big world out there, full of opportunities you may be ignoring. Sadly, we live in a world dominated by a fear of missing out, or FOMO. And in the last 10 years, U.S. equities and bonds have outperformed and generated massive amounts of FOMO. This hasn't always been the case. In the mid-2000s, the best performing markets were international equities, especially emerging markets, gold and commodities. So what happens if growth collapses and inflation becomes the new norm? Or what if the US dollar collapses and US assets are no longer attractive? What will the new FOMO markets be? And will your portfolio keep up or be left behind? Enter Rational Resolve Adaptive Asset Allocation Fund, ticker RDMIX, a strategy that is designed to thrive across different markets and economic regimes. Unlike most traditional strategies that keep allocation static and let volatility happen, adaptive asset allocation applies a proprietary systematic process designed to dynamically transition toward thriving asset classes and eliminate those that are not, all the while aiming for consistent volatility and stable returns. There's almost always a bull market somewhere in the world. Don't let yesterday's FOMO get in the way of tomorrow's opportunities. Instead, let adaptive asset allocation help you fill in your domestic portfolio gaps. To learn more, visit rationalmf.com and check out the Rational Resolve Adaptive Asset Allocation Fund.
All right.
You caught me drinking.
Welcome, gentlemen, and what a Friday. Welcome to this Friday.
That's right. It's a Friday.
Welcome.
Not our
What's
favorite
everybody
Friday,
drinking
but better
today?
than last Friday. Am I right?
Yeah.
Better than last Friday. Adam, you drinking a La Croix? What's going on, buddy?
Yeah, I have to officiate at a swim meet again tonight, so they don't like it when I show up half cut.
They prefer you fully cut?
That's right. Yeah, exactly. Either not cut or all the way.
What's everybody else drinking?
I'm having it's a Scotch kind of Friday, so I needed something with a little hammer to it for me. But
yeah, I have a 2018 Napa Cab. I apologize wholeheartedly to the Market Huddle, the Market Huddle team, Lena and everybody. I'm supposed to be drinking rosé. We ran out of rosé, so I'm on to my 2018 Napa Cab. Don't fix what ain't broke.
You drank all
I'm
the
drinking
rosé
this
today?
straight out of the bottle, like straight up. Just anybody have a
all the
straw?
beer too.
Show them your IV, Rodrigo.
That's right.
Show them the drip, bro.
All right. So
It's a little
hey,
glass action.
great to have you on, Darius. And just as a reminder for everybody watching today, that this is for education and information purposes. It's not investment advice. If you're getting investment advice on YouTube from four dudes on Friday afternoon, having a drink, then, well, I don't know, maybe that's the wisdom, but maybe not. But I leave that to everyone to make their own investment decisions. But we do have with us, joining us today, Darius Dale from 42 Macro. And they're over there democratizing the world of financial information for broader audiences and doing a hell of a job at that.
Oh, thank you.
And so Darius is going to join us today, I think, in what is an opportune time to be chatting, because there's a lot of shifts going on and the regimes going on, and there's impacts for inflation and growth that are having the fall-on effects of the asset price changes. And a lot of this is quite structural and predictable. So it's very interesting, and really going to enjoy having Darius on to chat with us about all these things. And just a slight change of the format, we're gonna share some insights of what we have observed over the last week as well, to start the show off as well. So Adam, maybe I'll kick it over to you to.
Sure. Yeah. And looking forward to people's comments and questions as well as we go through this. So please chime in and engage. And Darius, looking forward to your thoughts on what we've seen over the last week or so. I know we were chatting before the show, and there seems to be at least a growing consensus that we may be in some kind of regime change here. We are seeing a variety of signs. One thing that I've really picked up on over the last 2 or 3 weeks is we are in one of the most reflexive markets that I've ever seen in my career, going back over 20 years, where you've got sort of a confluence of extreme retail investor speculation and participation in the markets. I mean, just looking at the volume of odd lot call premiums, for example, the amount of gamma in the market on some of the highest priced names, thinking sort of the Teslas of this world. And at the same time, you've got a Fed president that's been reconfirmed, or Fed chair rather, that's been reconfirmed. And I think it is often the case that when we have a new confirmation or a new Fed chair, they often like to come out of the gate signaling that they're not going to be the same as the previous chair, and or that they have their eye on the ball. And so I it seems like there was a dramatic shift in tenor in the market really since the Powell reappointment. So I think that's an important thing to notice. We've had some other really interesting market-oriented signals, like what's going on in the Eurodollar market. I know the guys over at Alhambra have been remarking on the fact that we've had an inversion further out in the Eurodollar curve, which has often indicated a risk towards the deflationary camp. And so, is that complicating views on the trajectory that the Fed might take? And, I know a large group of macro commentators have been calling for this dynamic where we may get this sort of huge energy-led uptick in inflation expectations, and that may then cause a reaction from the Biden administration and some governments. They've been sort of signaling that they won't let this inflation get out of control, or they won't allow it to dent the economy, and their willingness to add to fiscal stimulus here. And so you've got this sort of, inflation shock may actually lead to an exacerbation of the same dynamics that have led to this inflation shock. And at the same time, you've got signals that certainly the bond market and the Eurodollar market are positioning for deflation. So, I think what we're really observing is a market that is ripe for inflation volatility, right? And so I don't think investors necessarily want to be concentratedly positioned towards the inflation camp or towards the disinflationary camp. I think you want to be positioned for inflation volatility, and there's a different type of trading dynamic that lends itself to that view. So maybe I'll stop there, and maybe you guys can react to that, and then I want to share a couple of charts that we thought were really interesting from last week.
Yeah, I think we've been talking about inflation volatility quite a bit, right? I'm particularly sensitive to the inflation discussion because of my formative years in Peru. A lot of people think they understand inflation, but they don't. I mean, inflation is such a broad series of events that don't happen all at once. Canadians especially love to talk about inflation protection as their gold position, right? It may work, gold may be there, and it will be there in certain ways, but if we're looking at quarter to quarter, the ways inflation manifests in different asset classes and different commodity complexes is wide and varied, right? Gold has been flatlining this whole year. You had energies going up. You had, grains at times, we're short the grains. At times we're long the grains. Like recently now we're back to being short energies after what happened last Friday. And so when people ask me, is it going to be, persistent and pervasive over the next decade, or is it going to be a transitory inflation? The answer is yes. The answer is that inflation decades are what you said, Adam. It's a decade of inflation volatility, thrusts upwards of massive volatility spikes with deflationary busts, and another round of deflationary busts. And from point to point, like decade of the 70s, commodities generally were up 800% for the decade. So you use this concept of like, look, commodities are great to hedge that decade. The problem is the average investor, the average advisor, the average allocator will be fired or just have weak hands in those moments of downfall. So I think inflation, unlike growth, requires a bit of a Midas touch. You need to be active in order to protect and manage that volatility of inflation, rather than just thinking a single passive position in your portfolio is going to do it.
Are we also in a place where the sort of Fed put is previously was all news was good news. If it was weak, we were going to get liquidity. If it was strong, we were going to get liquidity. And it feels like now that those players are backed into certain corners, both somewhat politically as well as fiscally, as well as monetarily, where now it's starting to be like it's all bad news. The economy's really strong. Oh, we're going to taper more. We need to raise rates more. So you'll get news that typically may have been good news in previous types of cycles, which is now potentially has some other implications to be sort of negative news. Yeah. And so you can get this cycle where the news is just, it doesn't matter what it is. It's all kind of temperate and creating that volatility you're talking about.
Yeah.
I would add just the news today, in our opinion, certainly added to a lot of that volatility. If you look at the jobs report, obviously the headline number was a pretty soft figure, but the second you take a step back or step through the headline numbers and into the data, as we tend to do, it's a pretty hawkish report. We saw some pretty broad-based improvement with respect to unemployment rates of ethnic cohorts that had been previously left behind, namely African Americans and Hispanics. We saw a massive improvement in unemployment rates or in employment for folks who don't have a high school diploma or folks who just barely graduated high school. And so in terms of the Fed's maximum inclusive employment mandate, this jobs report took it a major step forward, beyond that, or underneath the headline figures. And I think that does put the Fed on a preset course to accelerating the taper on the 15th of this month, and ultimately getting themselves into a place where they can hike interest rates in the first half of next year, likely at the June meeting. They'll probably get another rate hike at the September meeting. And the reality is that the fact that we're sort of on I think markets are pushing us towards a preset course for that, if only because the Fed has been so lagged with respect to the yield curve. It's been behind the curve for quite a while now. As a function of that, you kind of have a scenario in asset markets where, the Fed is going to be automatically tightening for tightening into a slowdown for an extended period of time. And that is a very different market environment than the one we just exited, or the one we're, either currently in or certainly in the process of exiting. So I think that does require.
When did that jobs report come out?
Yeah, jobs report. Oh, this morning at 8:30, the November jobs report. Yeah.
All right. And in terms of news, what do you think was a catalyst for last Thursday, Friday?
Oh, last Friday. I do believe Omicron was an issue, but I mean, it's all these dynamics. It's you don't necessarily need the catalyst, in my opinion. You need to understand how asset markets are pricing it in regime terms, and what happened, going into the beginning of last week, prior to last Friday's Smackdown, is that we sort of concluded the end of the mini reflation trade that we saw basically from mid-September through that time period, and we transitioned into something that looked more like stagflation, or inflation as we call it, at 42 macro. And so that was confirming the markets were pricing in a negative growth dynamic relative to the prior regime. Well, fast forward to this week, what's happening is now we're starting to price in a negative inflation dynamic as well. And historically, whenever you had both growth and inflation impulses are negative in the economy, or the market's pricing that in, that's obviously something that catalyzes more volatility, more drawdowns in risk assets, and a lot more sort of investors running for cash.
Yeah, I mean, I definitely want to zero in on the volatility in risk assets, because I'm not sure that people who are mostly focused on equities understand just how large some of the moves were across many markets last Friday, and then again on Tuesday this week. Like if you're only looking at the S&P, I think there's a lot that went on under the surface for the S&P. Obviously, the equal weight index, the Russell, were down in the sort of 4% range. So obviously a substantial move there. A lot of European markets also had major moves, thinking the IBEX, et cetera. So I just wanted to sort of show a chart that puts some of these moves in perspective. So let me just go ahead on that. You let me know when you can see my screen.
Mm-hmm.
You can?
Yep.
Yeah?
Yep.
Yeah. So this is from last Friday. So, a week from today. And all I did was I analyzed the size of the loss in terms of the the empirical distribution, in other words, all of the other returns that we've observed throughout the entire history since inception across 85 different futures markets. And I zeroed in on the ones that had the most extreme moves. And you can see that, for example, the crude contract, Brent, in fact, the entire energy complex experienced a downside move that exceeded what we have seen historically in all but about 20 out of every 10,000 trading days, right? So, I mean, that's a pretty substantial VAR shock. And a lot of systematic funds, especially, were relatively highly weighted in the crude complex because it has been such a strongly trending market. It has been symbolic of this stagflationary regime. And it was a bit of a market darling and had done very, very well, strong trend across a wide variety of tenors. So the other thing to notice was that the volatility observed in those markets coming into last Friday was such that the move was even more extreme when you adjust it for the volatility estimates, right? So in this plot, all we've done is scaled Friday's move as a multiple of the expected volatility of those markets. And again, this is the number of occasions per 10,000 trading days that we might expect to see a move of that magnitude in a wide variety of markets. You can see that on a vol-adjusted basis, a much wider variety of markets experienced quite a substantial move, right? So worse than we might expect in all but 20 days out of 10,000, right?
So for the listeners out there, we're looking at a bunch of graphs with a number on top across these markets, and I'm looking at, I would just say an average here, a median number of like maybe 5 days for every 10,000 trading days. We've seen moves like this across 15 to 20 different contracts or markets.
Yeah. So this is what was going on under the surface, right? That you didn't see if you were primarily focused on, a U.S. balanced portfolio or the S&P or the NASDAQ. And then the 30th, which was just past Tuesday, was actually another really interesting day, but it impacted even more esoteric markets, right? So just looking at Tuesday, the grains complex and some of the softs also had a really tough day. So, bean oil, mill wheat, cotton, palm oil, wheat, canola, all experienced an extremely negative day. The grain complex was at or very near an all-time high. The vol was relatively low. And yet, we can sort of hypothesize that some of the de-risking that some of the systematic funds were undergoing as a function of the VAR shock that they'd experienced on Friday, then sort of migrated over into some of the other complexes where there was fairly heavy concentration. We know by observation the grain sector was one of those. And as a result, we saw another really rough day for that complex. And again, on a risk-adjusted basis, we see the same sort of thing in the grain complex, just a really, really tough day. So, I think it's really illustrative to think about markets other than the S&P in terms of, what's going on under the surface and the type of risk that can manifest especially for sort of alternative strategies.
And it just so happens that it came at a time, like everything that Darius spoke about, it was clearly building up toward that, right? But what was interesting in terms of news is that we were talking about this on Thursday. Remember, Adam? You're like, this Omicron thing is coming in hot. Yeah, I wonder how this is going to affect the markets, given the weaknesses we're already seeing. You were talking about the deflation trade. Like you were very much into like we need to we're going to see how it's going to turn out. And certainly Omicron, I thought it was that the guardians of the narrative were all eating turkey dinner on Friday, right? Because I was looking at that. I remember that's Slack exchange. I was like, this is nonsense. Like, this is one of 20 variants. What are they talking about? Like, there's no data to back anything that the UK was doing. Whatever, it's probably not going to be a big deal. But when you don't have the guardians at the gate, right? When you have people, rational people that know about this, taking the other side, and you have all these dynamics in the background, and you're in one of the worst, the least liquid days in the year, it just created this Armageddon, right? Like it was astounding to see how you never know what narrative is going to create this catalyst.
Markets
I think it's just one last point I want, because I think this is going to dovetail well with your concepts, Darius, and 42 macros. Thinking, we have those two dynamics of inflation and growth that create those sort of four quadrants, right? What was heartening to some degree is if you were diversified and prioritized some preparation rather than prediction, our risk parity mandates were relatively unscathed through all of this, because you've got risk balances across the different domains that we're talking about, and some of them benefited from the regime shift and some of them were hurt. And so that's for us always a great starting place. And then obviously the layer on top of that is to think about, okay, prediction, and how do we inform that via, some of the quantitative models you've got, Darius, that help people slant and skew the portfolio to these different areas. We wouldn't advise that anyone takes, 100% off the table in any area, but certainly slanting and tilting the portfolio makes a lot of sense. But you leave that to the individual investor to do. But thinking about it in your quads concepts and all that sort of stuff, how did you see things roll out?
And maybe do intro 42 macro before you get into it and what you do, and then go forward and answer Mike's question.
Yeah, absolutely. It may help to sort of explain the grid concept, if you will. So let me share my screen if you don't mind. Yeah. So so I'll take a step back and kind of address something Rodrigo said earlier about kind of the guardians at the gate being missing, and I do believe that was certainly a factor. Can you guys see my slides? Yeah, you can see.
Yep.
So I do believe that was certainly a factor, but I also think it's fundamental as well. I mean, you think about what we learned from my man Andrew Lowe up there, and I think it's MIT. He taught us that markets are this dynamic, nonlinear ecosystem. It could have been Omicron, it could have been a squirrel getting hit by a bus, it could have been Powell saying the wrong thing at the Senate testimony this past week. And the reality is, we're heading into a sea of Ds. And what those Ds mean, those Ds implies that the whole global economy is going to be experiencing negative impulses on growth and inflation for an extended period of time, starting in roughly Q1 of next year for the most part. And so when you look at something in terms of how our market regime nowcasting process absorbs that information, or really, what it's doing is actually, sort of asking, every market in the world, all the major markets in the world across asset classes, hey, what's happening with your price and volatility signals? And, in the context of summer rising, all that stuff, we're effectively nowcasting what regime the market is in based on all those liquid asset markets. And what we've seen is really since the beginning of November, we've seen a massive move higher in both inflation and deflation. Inflation, because that's the highest probability macro regime right now. We're currently in the month of December. A lot of economies are in inflation, which is what most folks would call stagflation. That's where growth is decelerating, inflation is accelerating. But the reality is, if you look closely back at this chart, deflation is not far behind.
Can you just stop at this chart for 1 second, Darius? I'm not sure I fully comprehend what's going on here. Maybe walk me through what I'm supposed to be seeing here.
Yeah, absolutely. So it's a 3-step process or a 2-step process. So each of these markets in this table here, we're scoring through the lens of what we call our volatility adjusted momentum signal. And so if it's green, it's got a check mark that's bullish, red's bearish, orange is neutral. And so if something's bullish in this table, for instance, or something's, let's use the first signal, the MESA. So that's the MSCI Emerging Market Index. That's got a red X, that's bearish. Historically, based on the back test, if you look at how we back tested asset markets through the context of those regimes, if the MSCI Emerging Market Index is bearish, that means both inflation and deflation are getting a point from that market. And we're iterating that process all the way across the table, obviously, at every, interval and every trading day in the market. So we have a time series effectively of, okay, which regimes is the market pricing in according to how the asset markets have historically behaved in each regime. And right now we went from a scenario where inflation a few weeks ago, was up there around 20, sort of had a lower high relative to where it peaked out in June at around 20. And it was the dominant regime, as you can see at the top of this chart. But since then, we've seen the number of markets that are either breaking down with red X's or just breaking to neutral from bullish previously, that those signals don't contribute. So you're effectively taking away signals from inflation and either giving them to nobody or giving them to deflation and inflation. And so that's what's happened in the last few weeks, which is asset markets themselves are now concerned that we're transitioning into what we always thought they would transition to all along, which is having to price in a very different economic environment than the one we just left. this is a very positive economic environment, and the fact that we were getting record fiscal stimulus and record monetary easing associated with that very positive economic environment. The R stand for reflation. That's where growth and inflation are trending.
And that was from July 2020 to basically October 2021. Yeah.
Yeah. So I think that's the market saying, hey, we're done pricing in all the good stuff. We're now starting to price in the bad stuff, and what degree to which the market's pricing the bad stuff, in our opinion, is a function of monetary policy. The kind of expected path of monetary policy, which in our opinion is kind of getting scary. I mean, so we're seeing so this chart here shows the euro dollar futures curve. 2022 is the blue line, 2020 is the euro dollar calendar spread rather. Red line is the 2023, black line is 2024, and the 5-year, 30-year the treasury yield curve is the pink line. We're still hodling at around 3 rate hikes into 2022 and a couple more, 2 to 3 more in 2023. But what's happened is the market has said effectively, hey, look, you're going to tighten us into a recession as a function of that. And that's so the yield curve is pancaking, and kind of the last thing I'll end on this, we held in with the 10s-2 spread. We knew all the other yield curves are flattening, 10s, 30s, 5s, 30s, things like that. But the 10s-2s were holding in because we had this positive growth dynamic associated with, coming out of Delta. And, there's positive fiscal, for a moment, there was positive tailwinds with respect to fiscal policy as well. But a lot of that stuff has kind of gone awry in the last few weeks. And now you're seeing this collapse in the 10s-2 spread to kind of catch down to where the rest of the yield curves are coming in. To me, that's new. This breakdown in the 30-year treasury is new. It's kind of the fact that the 10-year didn't hold 140 where it held in kind of early November is new. And so to me, that newness of it all is something that we need to be paying attention to. Lastly, going back to the original slide, which is this.
Got it.
And then what are the implications then for bonds in sort of this deflationary outlook, but also with sort of a rising rates backdrop? Like, what wins in that?
Yeah, it's bear flat.
Adam, I think you're muted, Adam.
Yeah, pricing in inflation and pricing in deflation seems like a really interesting story. Like, how often do we see that historically, and what does that market environment typically look like in terms of where stocks and bonds go?
Yeah, so it's the difference between inflation and deflation is not much in terms of asset market performance. Like, if you look at so we back tested everything through the lens of those grid regimes. And the reality is when you're on the right side of the chart, that means growth's decelerating. On the left side of the chart, that means growth's accelerating. And you sort of look at like what happens in, equity style factor terms. It's pretty much the same thing with fixed income. The only big pivots in fixed income is like, okay, I'm going to be long, something like MBS as opposed to TIPS, or I'm going to be long, so I can actually get long the short end of the curve as opposed to IG credit or something like that. And so, the reality is, so inflation, a lot of folks associate, kind of stagflation with, okay, I got to go buy every commodity in sight, or I got to go buy this. But there's a reality to it that you typically only get paid in energy and food when you're in a growth slowing environment and inflation accelerating. This is the inflation environment that gets you paid in everything, commodities, everything, crypto, every inflation trade or inflation narrative that you want to put out there. When you cross this Rubicon of growth, things start to get weird, and the reason they get weird is because you're slowing, and the slowdown of growth, reduces investors' willingness to take risk, reduces businesses' willingness to take risk, and then obviously it creates a much more higher volatility environment. If you look at something like our back test for the S&P, for example, you look at the volatility is around 11 or 12 when you're in Goldilocks and inflation, but you're somewhere between 15 to 20 on average when you're in inflation and deflation, and that's pretty consistent across all risk assets.
I imagine if you added the balanced portfolio, sort of the 60-40 is the predominant way that investors would view that, it's not much better. Does the correlation between sort of the government bonds and equities rise a little bit in that scenario, or not?
Yeah, the inverse correlation tends to pick up whenever you have growth slowing. So that typically is what I mean. That's obviously what's happened in the last week or so. Last week over week. Mm-hmm. I mean, bonds have had a massive move higher as a function of these dynamics, in our opinion, changing. I mean, it's all reflexive, right? Bonds having a massive move higher is contributing to the nowcast for inflation and deflation rising. And the only reason that inflation and deflation are they're all rising as a function of risk assets selling off. But the fact that you still have some latent bullish signals in commodity space are keeping inflation well bid for now as a market regime. But certainly if we continue down this path, that'll be that'll end pretty quickly.
How often do you measure it?
Every day.
How often do you update? Oh, okay. So have you not observed a meaningful shift in some of those inflation dynamics over the last, even over the last week?
Yeah,
certainly
absolutely.
In the energy sector. Yeah.
Yeah, certainly. Initially, crude oil's bearish from the perspective of our model already. Let me go back to the table. Just I'm not speaking out of turn, but we got what broke down. So crude oil broke down, copper broke down, silver broke down, nat gas broke to neutral. Where we at? Yeah, so you had a lot of breakdowns this week. Obviously, MSCI Emerging Market Index breakdown, but you had a lot of stuff break down to neutral already. And so we're on a path towards going to deflation. And that's typically what happens, right? Like if you look at this chart, it's very much akin to the business cycle. Like you bottom here in a recession, then you grow while inflation is still decelerating. That's kind of the early cycle phase of the recovery. Then you go kind of to the early to mid cycle phase of the recovery. You got inflation picking up now. There's a little bit more pricing power in the economy, and then overly you start to overheat. That's where growth's decelerating late cycle and inflation still accelerating, and then boom, you have your recession. Right? That's kind of like this is designed to help investors manage risk on a kind of 3 to 6 to 9 month forward basis. But the reality is it very much rhymes with how the business cycle itself works in rate of change terms.
Yeah, you got the cyclical changes, what you just described. There's also a secular regime that tends to be much, much longer, right? But you're dealing in the cyclical. So what type of visibility do you give your clients? Are you predicting what's going to happen over the next 12 months, 6 months, 2 months, 1 week?
Yeah, 12 months. Yeah, 12 months. So our forecasts are live and rolling at every interval. So we maintain nowcast and forecast models for both growth and inflation for every economy. Going back to that table on slide 5. So it's all the same, kind of metric processes, but obviously different data sets per the different economy. So we do have at every interval, we have a 12-month forward view on what the modal outcome is from a regime perspective. Now, that's not to say that every modal outcome dot in this, in this first row of the table is as strong of a signal as, as the others. For example, when you're in reflation from July all the way through kind of from July to July, these were very strong reflation signals. Your distance from the origin was very great. And as you can see, the conditional probability of being in reflation throughout that time period was very high, as a function of the distance from the origin. Now you're kind of in this, hodgepodge of, this, starting in September of this year, really all the way through kind of the end of this year, the distance from the origin for some of these dots is just not that far. And so the market, in my opinion, going back to the market regime nowcasting process, this is why I draw the dotted line. It's like the market has had a tough time figuring out what regime to price in because the economy itself has had a tough time of declaring the regime, if you know what I mean, of actually declaring the regime. But we think as we go further into 2022, as a function of our growth forecast, this pretty consistent deceleration in growth, pretty consistent deceleration in inflation. The further we go into 2022, the more likely it is the market can figure out what to price in. And maybe that process has already started.
So how do you trade with a 12-month forecast? Or how do you recommend investors manifest these views in portfolios?
Mm-hmm. Yeah, absolutely. So what we're trying to do is orient our portfolio construction in accordance with the next 3 to 6 months on a from a conditional probability perspective. So right now we mostly the next 3 months, because what we found, I've been doing this for over a dozen years now, and anecdotally, the asset markets tend to start to price in the new regime somewhere between 1 to 3 months, not further. Jim Leitner, who runs Falcon Head, I forget the Falcon something, but he was in Inside the House of Money. This is back in 2008, a book in 2008, and he was talking about the regime segmentation process and effectively how you don't get paid to be front run the regime. You typically want to be kind of within the first couple months of the regime. And so that's, understanding that, understanding just kind of watching this process play out anecdotally over the, long period of time.
That's an interesting concept. So just so that I understand it, it's you don't get paid for being too early, right?
Yeah, of course.
This is kind of like, how many people before '08 were like in 2005, I was hearing calls
Totally.
for the real estate housing market collapse. I mean, most of the people in the big short were big shorting years before they should have. And
Totally.
became
You get parted out.
ostracized, like lost their families, lost their their
Well, I mean, thank
sanity.
God. I mean, my former boss got fired for shorting too big, and I wouldn't have had a job had he not gotten fired. So, I'm knocking wood, that was a good thing. But
Druckenmiller shorting too early. Like, it's an interesting concept. So you're better off actually taking the first hit along with everybody else. You're not
yes,
going to get fired if you're taking the first hit with everybody else. You just, from then, don't be paralyzed. Start making some moves.
exactly.
I like
So
that.
just wait for the market to tell you, hey, we're starting to price it in. That's what this whole process is about. I know based on the the econometric side that this is easy or easy enough for someone who's been doing it for as long as that. The hard part is this variable kind of dynamic with which the market starts to price it all in. The market can start pricing in like coincidentally, like Q4 of 18 when we transitioned to deflation then, and the market effectively was like on the day on the screws, or it could kind of start to price it in, ahead of time. This is like, you look at January of 2020, a couple months ahead of time before we actually observed and experienced the deflation. So the reality is you kind of want to live in this next 3 to 6 month view, but really the 3 month view. And so our portfolio construction, I'll give you guys a quick glance at it because I don't want, we've got to keep our ETF exposures out of the public view just for, respect of our paying subscribers. They're paying for that information. But the portfolio construction, the bets we're taking in the portfolio construction from a pie chart allocation perspective will represent the grid regimes, the size of the grid regimes in this probability table. And so now, as you might imagine, inflation had been the largest one, but we actually just made some sales today, so we're a little bit more balanced with deflation down cash.
So I'm not clear as to what you recommend, like what instruments you recommend be used.
Yeah, so
mainly equities.
Just everything. Yeah, so we've backtested everything through the lens of those grid regime processes, through the lens of the deltas, the impulses in growth and inflation, what the policy rate's doing, what the balance sheet's doing, what the fiscal policy is doing, what the rest of the world's doing, and we blend it all together through the lens of volatility or expected returns, percent positive ratios, volatility and covariance. So volatility and covariance are on the x-axis here, percent positive ratios and annualized expected returns on the y-axis. And what we're trying to do is help investors visualize according to our forecasts of what's happening over the next 3 to 6 months in the econometric side of things, visualize the kind of exposures they should be long and short. So if you draw like a slope of 1 here, you obviously those would be the longs, these would be the shorts, high risk, low reward, low risk, high reward. And so we do this across every asset class: U.S. equities, global equities, commodities, fixed income, foreign exchange. And then we ultimately help investors, kind of shrink that whole discussion into, okay, these are the types of exposures I should be picking from on the long side to get into, to fit myself into one of those pies, right? And so that's that's how the whole process works. It's understanding the conditional probability over the next 3 to 6 months of realizing something in the economy, allowing the market to say, hey, it's actually starting to price that in, and then making sure the bets we're making in our portfolio construction correspond to the size of the pies or the size of the probabilities in that distribution.
I think that's a really important point to emphasize, in that you've got a pie there, and it's unlikely that you're going to take any one of those quartiles to zero.
Yeah.
Like you're still going based on the conditional probability.
Or 100, presumably, too.
Correct.
Yeah,
correct.
Exactly.
And so based on the probabilities you're seeing, you're weighting the allocations to those various regimes based on those probabilities, because you would never have a 0 or 100 probability in any case.
Yeah. And so right now, Goldilocks is a 10% probability over the next 3 months in terms of realizing that economically. I took it down to 0. That's to be so just, I just don't just experience.
There's a threshold by which you just go to 0.
There's a subjective element to it as well. The subjective element is certainly less than a quarter of the whole process, but it is a function. There is a subjective element to it. I mean, the pivot we made in early November to start taking down our exposure to pure reflation exposure, we sold a lot of commodity exposures. We were long commodities coming into November, big time. And we sold a lot of that stuff at the beginning or November 11th, saying, hey, look, I'm starting to see the market transition to something that's not positive. Like we're coming out of reflation. It might be inflation first, but ultimately we're going to be going to deflation if you go back to that probability table. And I don't like these signals. I got to get rid of all this stuff. So I effectively use my own intuition and kind of my own expectations to front run the pricing in of that. And knock on wood, that was obviously a really good call because a lot of those markets have crashed in the last few weeks.
That's an interesting concept that we often talk about internally as systematic managers, Darius. You know, how do you weigh what you do as a quantitative investor is you try to minimize your own behavioral flaws and maximize the understanding of the structural inefficiencies that created your models that you believe are going to exist long term versus the intuition that you create and garner over decades of being in the market.
Yeah,
right?
totally.
That blind spot that a lot of these, you know, like there's 2 or 3 things that have happened. I kind of know that my intuition tells me this. I've seen this enough. And you are, you know, it's an interesting thing because you are both quantitative, but you will unapologetically nudge something using your intuition. Have you thought about that in any deep way where you can articulate it and kind of, you know, really hone in on when and why? Or are you just kind of playing the game and your intuition kind of kicks in? Like, where are you at with articulating that?
I'd say 5 years ago, I was just playing the game. As I've gotten more experience and built out the process better and more robustly, I have ancillary tools that give me quantitative signals that allow me to essentially front run the main line components of the process. And so, for example, you know, taking back to the deck, just one slide I'll share with you on that in that regard. You know, so when we were making those pivots in early November, this dispersion table, one thing we track is month-on-month Sharpe ratio dispersion across 50 U.S. equity sectors and style factors. The reason we look at the upper quintile relative to the lower quintile, but what we're trying to find is the composition of the upper quintile and lower quintile, specifically if it's pro-cyclical or defensive. And the reason we do that on a daily basis is to identify, hey, what side of the table is the market maker on? Because what typically happens, and Stan Druckenmiller taught us all this going back to 70s and 80s, like the style factor leadership in the stock market is the world's best predictor. You know, it's the world's best predictor of what's happening on a go-forward basis economically. It's the world's best predictor of future changes in monetary and fiscal policy. And so, you know, understanding, having this burned into like the back of my brain, like, okay, what leads, what lags in a pro-growth or negative growth regime. When you start to see this table, so this table got very defensive in June. Like the upper quintile was dominated by things like low beta, mega cap growth, et cetera, et cetera. That was kind of the end of that.
That was in June, you said?
Yeah, that was the end of that first reflation wave. Going back to slide 9, like this peak, the peak of that reflation wave came, and then it crashed, and because sector and style factor leadership in the equity market sort of front ran that, saying, "Hey, look, we're done pricing in pure reflation for now," and it got very defensive. It got very pro-cyclical again in mid-September, and that was one of the things we used to say, "Hey, like, look, the market is not currently pricing in inflation from a dominant market regime perspective, but this dispersion table is telling me that it's going to be at some point in the next few weeks." And the converse is true in early November. After having been pro-cyclical from basically mid-September all the way through early November, it started to get defensive again. And to me, I was like, hey, man, this is the same analysis I used to front run the pivot back to reflation in September. Now it's telling me to pivot out of reflation and into something more defensive. And, you know, the same analysis I show with the S&P 500, it's the same with most commodities and everything else. You know, commodities want demand growth. They want growth. You know, they want to be in Goldilocks or inflation. You can get paid in energy and food and inflation, but your volatility on those exposures is going to be much higher. And so,
I want to zero in on this. This is like this is less about like I get where you're at, because we always, again, internally we have these conversations and we're like, totally. I see this pattern, and then we're like, well, let's just go ahead and put that into the system.
Yeah.
You know what I mean? Like at some point you've had 2 occasions in which you front ran the system. At some point you got to be like, I'm going to create a system around this, right?
Yeah. It's not just front running the system because I feel like it's front running the system with this in mind.
No, but this is my point. You have your eyeballs are telling you some stuff. And now you've discovered a pattern from your intuition. The question is, are you going to then quantify that and embed it into the system? And is that the evolution of all quantitative models at the end of the day?
Absolutely.
Or is it always going to be like your intuition because maybe there's something that you with regard to these two phase shifts that you front ran that they don't happen often enough for you to create a model. But anyway,
no,
I just find
I'm
this
glad
is
you
a
asked
very
that
interesting
question.
thing.
I do believe there's a model to be created now that you asked that question. So that's something we'll get some more. We'll do some work on that. I do believe so. The whole point, as you guys know, with quantitative analysis, you got to create time series. That way you can back test it and actually forecast it and ultimately use it in real time. And so right now I'm effectively using something that is not time series based, even though it's quantitative. It's quantitative based on the back test and all the learnings and understandings. So hey, look, when the market goes from defensive to pro-cyclical or pro-cyclical defensive, it's swapping on that going from left to right on that big table we're talking about. And so to me, seeing that change in early November was saying, hey, look, I don't want to stick around waiting on this actual pivot, because there's a lot of stuff that can happen in this month in particularly, and I said this when it happened. The June CPI report was one of the biggest catalysts of the year, or not the June CPI report. Sorry, idiot. The October CPI report. Not only did the October CPI report sort of put the Fed on a path to accelerating tapering and acknowledging that it has to tighten next year, but it also, in my opinion, is taking out the wind of the sails with respect to the Biden administration's agenda. I don't think they're going to be able to get 170 or 1.75 trillion past the Senate. That could be 1 trillion. If that's 1 trillion, what are we talking about in fiscal drag terms next year? We could be talking about a recession next year. I don't think that's the base case scenario, but I don't think anybody's talking about that in terms of what I see in the bond market and the yield curve, and what I see on FinTwit. Everybody's levered long inflation. I'm like, that's a weird setup to me.
Yeah, it's not matching expectations. Doesn't
Not at
matter
all.
if it's a billion or a
And
trillion.
I'm going to side with the bond market every time. not FinTwit, trust me.
Whoa.
So
Careful.
tell me a little bit about you keep using the word back test. So I'm curious what you mean by that, because it doesn't seem to be exactly the same as the way we typically think about back test. I think you're identifying a certain condition. So whatever, 3-month skew is X. When 3-month skew has been X previously, the forward return over the next 3 months or 6 months or whatever has been on average Y. Is that generally how you're approaching it?
No. It's actually. Can you see my screen?
No.
No, sorry. There you go.
There we go. So no, it's what we're trying to do is we're back testing observations in the regime on a time series basis. And so what we're looking at is annualized expected return for the 71 observations over the last 25 years when the S&P 500 is in Goldilocks. When the economy is in Goldilocks, this is the annualized expected return based on those 71 observations over the last 25 years.
So there's
so-
a trigger.
Okay, so you're using
there's
the
a trigger.
ensemble of
Yeah.
you're using an ensemble of all of your different indicators.
Mhm.
So you've got that ensemble. You can identify where that's the regime that ensemble was signaling that you were in, back through time.
Yep.
And then you can just sort of pull out those months where the regime was in that state, and what was the average return when the regime was in that state back over the past 25 years. That's the
Bingo. Yeah, that's exactly.
And it's either in that regime or it isn't, right? It's like a probability of that being in that regime. It's like it is in that regime or it isn't.
Yeah, exactly. And to address that point, that's the subback test. So each back, so the overall back test is obviously the whole sample, but then we have different categories of back tests. So hey, what does it mean when growth's slowing very quickly, or we call it -2 sigma growth delta? So the size of the delta on the deceleration is a -2 sigma relative to the trailing 3-year sample of deltas. And so, you typically get a bigger drawdown in stocks when growth is slowing at an accelerated pace, and inflation or deflation. Those are when growth is decelerating, or something like this, where growth's accelerating pretty rapidly, a plus or 1 sigma or +2 sigma. If you're in Goldilocks or inflation, you typically get a more positive market response. And so, we're categorizing all those different back tests. So we, in terms of, understanding, because it's all just historical data, right? We're just, we're relating the historical data to the price changes in the markets, and then ultimately, creating the statistics associated with that, so we can understand. And the goal of that entire process is to create this table, is to understand how asset markets generally behave, and then the secondary goal, the real goal, is to make money, right? and to help me, help myself make money, help the folks who subscribe to our process make money. And so we use all that secondary information alongside the primary back tests to effectively create these scatter plots, the visualization of it all. Say, hey, if I think we're transitioning from this to this, you don't want to be long things that only work in this, but might not work in this. You know what I mean? You want to be long things that work in both. And so that's how we really help investors, understand these regime pivots. We started the show by saying, hey, we could potentially be in a market regime, transition. Mm-hmm. Our bread and butter is helping investors, A, understand what the current regime is, and B, how to position for that changing.
Can you just flesh out what you mean by covariance ranking?
Mm-hmm. Yeah, sorry. Let's go back to the slide. So this is
you see that, Mike? You see, by the way, I just want to point something out. Mike always gives me shit for having too many slides in my deck. 131 slides, Mike. 131 slides. I'm averaging around 60. All right. Yeah. Just see, that's what you call the kitchen sink presentation right there.
Yeah. So I do one of these decks every month. I don't know why in the hell I decided to do that to myself, but it's actually been good. It forces me to interact with all the data more rigorously.
I agree. I think Adam is the winner here, though. I think I've seen on average like 100 slide decks coming out of Adam's. So within a day, he'll come up with 100 slides.
Parenthetically, dude, the number of slides is really just how big do you want the fucking charts to be on the page, right? You can put 4 charts on a page and take a 120 slide presentation down to a 30 slide presentation.
Very
It's just you can't see the goddamn.
If that's what you need to do to live with yourself,
Can we? Hey, that's a great way to sideswipe the conversation.
Slide deck link, MB.
I was following along great. I don't know what we're talking about now. Can we get back to
oh my God, Mike was super focused. Your Ritalin is like in full effect.
I'm focused in. I'm following the story.
Look at
Mike talking about
poor
you.
Mike.
All right, go ahead. I'm sorry. We just totally threw off Mike's flow.
Exactly.
I was trying to get some levity to the conversation, Mike. Just
no worries. Yeah, we're getting very nerdy.
That's normally your job, by the way.
And we apologize.
Fucking get going.
Watching us at 5 p.m. on a Friday, like, man, this is the boring stuff ever.
No, man, we got great engagement. We got amazing engagement, and nobody's asking any questions. Don't be shy.
We love this. We love nerding out. It's awesome. Just loving it. And it's also, I'm assuming in this case, you're not registered individual who has to all get everything through the registration process too. So there's some differences, but let's carry on. I want to get in the meat.
So yeah, real quick, we can transition into the discussion too. I just want to answer Adam's question on covariance. So in the same way they were calculating the annual expected returns of percent positive ratios of volatility, we're also calculating the covariance with U.S. equity beta in the regimes. And so taking the time periods of those of each exposure that we backtest literally everything that ticks. And so, for example, you're looking at bonds. This is the Bloomberg Barclays 25-year total return index. The further, as I said earlier, the further you get into inflation deflation, that inverse covariance picks up with the S&P 500. So
it's beta to SPOOs essentially.
Yeah, exactly. And so when you see that ranking on these scatter plots, we're taking that this table here. We're trying to blend it all together to, there's a proprietary process that I'm not saying is perfect, but I think it's pretty good in terms of blending all these back tests together, and then we just rank them. And so the ranking allows us to calculate a mean value for them, and the mean value allows us to plot them on the scatter plot. And so we got a mean value for covariance volatility on the x-axis and a mean value for the expected return of percent positive ratio on the y-axis.
Yeah, I'm loving it. So help me understand how you translate that scatter plot to a portfolio. Mm-hmm. You don't need to actually show me the portfolio. I know that's proprietary, but I'm just keen to know how that works at your end.
Yeah. So going back to the pie chart allocation, so the size of the slices of the pie correspond to the percentage, the probability of realizing the regime over the next 3 to 6 months, mostly the next 3 months. And so if let's say I need, just to fill up, 50% of the portfolio with deflation exposures, for example, I'm going to go to the deflation backtest and those scatter plots and go pick dots from the top left of the scatter plot. The top left.
So which dots do you pick, and then how do you size them?
Yeah, for example. So for now, I've experimented and failed with mean variance in terms of sizing. So right now we're just sizing them up equal weights. But so for example, in fixed income, if I'm, we're trying to, let's say we need to add fixed income dots in the pie chart. Well, let's go find things in fixed income that have a high, reward score and a low risk score. So that's be short-term treasury, tips, MBS, kind of a treasury belly, or that's 7 to 10 year. This is ag, TLT, ADV. It's kind of the usual suspects, exactly what you would expect. It's obviously not things like, BDCs, high yield, convertible bonds, bank loans, emerging market debt, EM, local currency. So the scatter plots help me fill out that, that slice of the pie. And so if I'm using equal weighted exposures and I need to get, to 50, for example, that's going to be, a little bit more. That's going to be 12, 12 different slices or 12 different, dots. So I've obviously got to run out of dots in this particular back test. So I got to go find them from other asset classes that kind of mimic that exposure. Fixed income would be the closest one in terms of volatility.
Okay, and all these recommendations are non-levered.
Yeah, no, that's. I don't believe in leverage, man. That's how you blow yourself up.
Whoa. Okay. Well, we have how much time do we have left? We have 35 minutes left to talk about that.
I think I'm understanding. I mean, it's interesting to me that like EDV with a duration of like 30 is equally weighted in there with SHI with a duration of like 2, right? Mm-hmm. So, and then I guess there's at least 2 steps to this. There's the asset class allocation, which is informed by the regime probabilities, right? And then, so that you've got that sort of pie weighting. And then within each of those asset classes, you've got a list of exposures that are expected to perform well in that regime. And you just sort of take some mix of those exposures and kind of equal weight them is kind of the general portfolio construction concept.
That is correct. Yep. And well, it's not there's one more layer. There's the slice of the pie that corresponds to what we expect to realize in the economy, because what we expect to realize in the economy, we infer that the asset markets are going to try to price that in the market regime sense. And so the slice of the pie corresponds to that part of the process. What asset classes I'm using to fill up the slice of the pie corresponds to the back test. Okay, so in inflation and deflation, I know I need more fixed income exposures because they have a higher expected value than equity and commodity exposures. However, if I'm in reflation or Goldilocks, that's the opposite is true. I want less bonds and more risk assets. And so that's that part of the process that's kind of not depicted here, but it's sort of automatically inferred.
Okay, and then how do you incorporate the beta?
What do you mean? I'm not sure.
So I'm just thinking about, you've got your chart, you've got all of these markets that do well in a, you want to be in fixed income, and these are the markets that are, or let's say you want to be in equities. Mm-hmm. How does the beta ranking kick in terms of the assets that you want to hold in the portfolio? I mean, I understand it's sort of like above that line, but it seems like by just using that line, you're actually eliminating that covariance or like market beta dimension entirely. So I'm just wondering kind of how that feeds into the process, or how you think about that.
Yeah, so that's exactly the point. So if I don't have the reflation or Goldilocks scatter plots in here, or do you mind? Let me share one more time.
Yeah, go for it.
Yeah, I don't have the. So looking at equities in particular, so you want more beta in Goldilocks and reflation. So for example, if I'm in equities, if this was, Goldilocks, for example, there'll be a lot of dots scattered up here. You know what I mean? It'll be like high beta, the Qs, tech, industrials, energy, financials. You actually want that beta, because it's going to give you that beta, that volatility is actually a positive feature in that regime. You're getting more return, per unit of your risk. However, as you notice, all the highest dots in these 2 risk-off regimes and the regimes where growth is decelerating, all the highest dots are where you take the least amount of risk. And so that to your point, Adam, that's a great question. It's like, how do you know how much beta to take or where to get the beta from? It's a function of what regime you're in. When you're in inflation and deflation, you want to be congregated to the upper left. Generally, you want to be congregated to the upper left at most of the time. But the reality is there are no free lunches in markets. You're not always going to get a lot of dots in the upper left, right? Typically, what you're going to see is, dots up here and dots down here. Risk, the risk tends to correlate with the reward. But there are times what this process allows investors to do, I think, at a really high level, is understand the anomalies in terms of the risk and reward you're taking, both to the upside, obviously for something like healthcare, but also to the downside for something like high beta.
Okay, so these plots are meant to be sort of a visual to help investors to understand that by virtue of being in a deflationary regime, all of the assets that you want to emphasize tend to be lower beta.
Yeah.
And if you're it's the beta's not really, you're not really using that to select the assets so much as to illustrate that we want to be in low beta assets, and we're selecting these assets.
Yeah, exactly. Now, if all like this circle that I'm circling here, if this circle was transposed down here, that would not be true, right?
Yeah, because they would have low expectancy.
It would have low reward. Exactly. So right now,
like you said, I mean, the Sharpe ratios of any one of these strategies, any one of these securities change over time. Right now, the highest Sharpe ratio is in the top left here, right?
Yeah, exactly.
And that may not be the case. Even though you might be selecting more volatile asset classes, the return might be so much higher that the Sharpe ratio for that moment is expected to be higher.
Yeah, you're absolutely.
And that's how you manage that.
You're spot on. That's exactly it.
Very interesting.
Yeah.
How often do the regimes transition?
Say what?
How often do the regimes transition? Like, have you seen, high confidence in one regime, this month, and then it shifts next month to high confidence in like the polar opposite regime, or does it tend to be more gradual? I'm just curious about your experience with it.
Yeah. So quantitatively or empirically, there's two transitions on average per year of going from what I would consider to be risk off or risk on, which is Goldilocks and inflation, to a risk off regime, i.e. crossing that Rubicon here. Two of these a year. So you have to go from one of these two to one of these two, because it's very easy to manage if you go from one or the other. Very easy to manage if you go from one or the other. It's really just the amount of how much risk you're taking in the types of exposures you're exposed to. But when you go from, one side of the chart to one side of the table to the other side of the table, you have to take different types of risk. And so on average per year, at least going back to the start of 1998, there's two of those to risk manage. But as you know, there's nothing average about financial markets. I think that's the scariest word in our business is average, is mean. As you see, this is a whole year of do nothing. You know what I mean? Now we're likely to have a whole year of the opposite, do nothing. And so
how dare you charge a fee?
Yeah.
How dare you? What am I paying you for?
Can you go back to your macro indicators page just for a quick second? I just want to have a look. And then how do you select those macro indicators, and then how do you weight them? Like, do they all have the same predictive power, I guess, by implication, that you're assuming they all have sort of the same amount of predictive power in terms of their ability to inform your regime model?
Yeah, it's not that I assume that the assumption is not that they have the same amount of predictive power. The assumption is that at any given time, any one of these markets could be the signal. So, for example, going into COVID crash last year, when we went into a big sharp deflation market regime, it wasn't like the S&P 500 was like the last thing to break down. What broke down, like, was the Mexican peso started breaking down in January. Brazilian real started breaking down. It's like, so the assumption in the model is not that these are equal weighted, but that you might get different signals from different markets at different points in time based on where the various policy dynamics or whatever that could also be impacting asset markets. So I've looked at this going into all the different deflation and inflation regimes that we've seen across time, and the reality is there's no consistency to what leads and what lags, and that's a learning in of itself. I think a lot of investors. I think one of the things we all do as investors is sort of, and this is all behavioral. Kahneman taught us this. We try to shortcut everything. So we say, oh, well, credit spreads, right? Credit spreads. You look at credit spreads.
That's a signal. It's over.
That's the signal, and we all agree that credit spreads is a signal, and it absolutely is. But it might not be in terms of the speed, in terms of, helping you reorient your risk management. It might not be the signal that gets you out soon enough. It could be the Mexican peso 2 weeks before. You know what I mean? It could be something like that. So that's why they're equal weighted. In terms of why this stuff's in there, there's no rhyme or reason other than that these are the most important asset markets in the world, or at least according to Darius Dale's view. I mean, you're talking these are certainly the most liquid market exposures in the world and the most trafficked in market exposure in the world, maybe with the exception of something like European triple C's, it's less likely, or crypto. I would argue crypto's an important market indicator at this point now, but some people might not agree with that. So yeah, no, it's there are 12 asset classes represented in this table, and so there's enough in there from the perspective of having a robust set of tools that gives you a signal ahead of time. Like that's what we're trying to do. The number one thing we're trying to do with all these these 100-slide presentations and all the presentations I put out every week is help investors not lose money. Like I think, yeah, go ahead.
Sorry, because I want to pull on that behavioral string, and I want to pull on your client base, because I'm sure you have a lot of data on the strategy. I'm curious whether you have a lot of data on your subscribers, because what you are presenting right now is absolutely the way that everybody should be thinking about investing, which is you want to be adaptive, you want to try to make money in good and bad markets. This whole idea of like you got to be investing in the S&P 500, Mr. Berkshire Hathaway, and that's the only thing you need to do, and just grit your teeth when it's shit, and then celebrate when it's up, never made any sense to me. What you actually want to do is be very different from that single market and try to make money most years, right? And while that seems rational, and in any newsletter, that's what people are offering.
Yeah.
I would imagine that it's very different than the S&P. Whatever your P&L ends up being, or whatever people, I'm sure people have a variety of choices. You're showing them a map, and they got to travel their own path. It's got to be very different than the status quo. And generally speaking, behavioral economics would tell you that not being part of a tribe is a bad thing. You're not going to be able to stick to it.
Yeah.
So do you have any data on the turnover of subscribers based on tracking error?
No, we're a 7-month-old firm, so we've only grown every month. So
you got to start. You got to you actually got to start pulling that data and analyze it later. But start pulling the data, because I mean, this is what I've been preaching from day one of my career 15 years ago, and it makes absolute sense. Theoretically, everybody buys in. And the moment you have a big dispersion from their whatever market is their home country bias, it's when they quit. Yeah. So, I don't think anybody here or you are promising that you're going to beat the S&P 500 every day, every month, every year.
No.
What you're promising or you're attempting to create is a better risk managed portfolio that does well over time, regardless of what the S&P does.
Well, beyond that, it's what you're trying to do is, particularly for folks who are at or near retirement, you're trying to eliminate downside capture in the portfolio. This is an absolute return strategy. So your benchmark should not be the S&P 500. Over time, you want to have S&P 500 like returns. Otherwise, you're not worth your shirt as an active manager. You're wasting your own time and resources. But the reality is, you don't beat the market when it's going up. You know what I mean? Like that's hard to do. You beat the market by not suffering a 20 to 30% drawdown, because you're long bonds, you're long cash, because of a process like this tells you to do that ahead of time.
Exactly.
So
I think
on that point,
that's a long process. That is a tough thing to stick to.
On that point, where are you seeing the largest dispersion between sort of what you would observe? I'm going to say the average investor, or you're only 6 months.
The average fin Twitter.
Your average fin Twitter. As you're onboarding these new subscribers and clients, where are they versus where should they be, and what are the largest gaps that you're seeing?
Yeah, that's a great question. I think this most recent couple of weeks, we're about as closely aligned as we have been throughout the entire process. I think because the markets were generally buoyant up until September, up until September, really, investors felt the need to take more risk in their portfolio, generally speaking, than the process would suggest you should be taking. And I think now, especially over the last couple of weeks and the pivots we've made, I think most investors are saying, hey, I think I kind of get the process now. It's telling me to take down risk. And let's be honest here, like whether or not you bought stocks in March of 2020, November of 2020, or April of this year, you've probably made a decent amount of money, right? It's this concept of like, oh my God, I need to be in it to win it after 130% move off the lows in the S&P 500. I think it's ridiculous. I don't think there's a lot of people out there that feel like they need to do that. I just think there's so much narrative driven investing around inflation dynamics and crypto halving cycles and all this stuff that like there are people who have these massive positions on that refuse to give up the ghost until it's probably too late.
Amen.
So that this keeps you in front of that. And then on that note, then it's sort of all those asset classes that you would see in your portfolio that you're adding, the reduction of risk, you're adding more bonds back, or you're adding sort of the risk off assets more than, say, the typical investor or investment advisor at the moment who's sort of stayed the course through thick and thin with their 60/40 and benefited from that probably fairly substantially over certainly the Goldilocks period.
Yeah, absolutely.
And so now there's the potential for significantly more differentiation in the approach that you're ascribing and the adaptation that you're ascribing.
Yeah, 50% of our that pie chart I'm talking about, 56% of that pie chart is in bonds, currencies, gold, and cash. 56%.
Right.
And those are two very recent pivots. Most of the portfolio was in high beta type commodity exposures heading into the beginning of the month or heading into the beginning of November.
Mm-hmm.
And so that was a very important pivot to start getting out of that stuff and rotating into more defensive exposures. Not to say we nailed it or anything. That's not the point.
It's a process, right? So it will change.
Telling you to start doing something different. Even the going back to Rodrigo's discussion, like even the leading edge of the process, like before the full process confirmed, was telling me to start doing something different. And so having kind of this human experience that I've had over the last dozen plus years of doing this, it's like, hey, maybe I don't want to wait for everyone else to have to sell their overweight inflation commodity narrative based investing story for positions. I said it, there's a bubble in narratives, and a lot of people are going to lose a lot of money in the next kind of 6 to 9 months, in my opinion, as a function of their inability to change their mind on something like inflation.
And how much time do you need for an asset class to contribute? Like you mentioned Bitcoin as an example. Does that have enough time to have a data series that can make a contribution to your models, or how long do you need?
I don't think there's a right answer to that, but I mean, it's got to be in there. I think the answer is it's got to be in there. I don't know if we have a good enough time series yet to see it go, because we haven't really seen it go through too many recessions and things like that.
Right.
I think you typically need to see multiple tightening cycles, multiple economic cycles to have a real true back test. That's why I keep it at 25 years on a trailing basis, because you're going to get a lot of that stuff in there. And so you're absolutely right, Mike. That's a great question. Like Bitcoin does not have that time series component to it. Moreover, it's a lot of the time series that it does have since 2009. It's just an adoption story. It's not a macro thing. It's an adoption story. I would argue, and we actually we start our Bitcoin back test at the beginning of 2017, because I do believe that's kind of the year where it became a real asset class as opposed to an adoption story. So that's
and when you look at that, what's the narrative that Bitcoin is non-correlated is true. A lot of things are non-correlated until the shit hits the fan, and then there are those things that are very correlated and massive drawdowns, and there are those things that are negatively correlated. And now right? Like, has Bitcoin ever been a massive protector during a massive deflationary cycle? No, I don't think we've seen any of that. We've seen bonds continue to do that. We've seen gold do that once in a while.
Yep.
Bitcoin continues to go down drastically when liquidity dries up. So it's I think we need to think about the diversification benefit of Bitcoin most of the time, but you have to recognize that it will suffer in a growth shock.
Yeah, of course. It's shocking to me that people don't acknowledge that, because
they don't. No, it's so non-correlated, right?
It makes a ton of sense when we talk about this with stocks, right? Like stocks and credit, like, oh yeah, if we have a growth shock to the downside, that's going to catalyze negative, expected returns in the equity market. But, for whatever, and again, this goes back to the bubble of narratives. Like Bitcoin is a narrative-driven investment vehicle, and it's increasingly less a narrative-driven investment vehicle as more people like us adopt the asset class and start to find ways to put it into a balanced portfolio. But until that's that process will be ongoing for the next decade, and until that process concludes, i.e., it's just part of the investment universe that we're all kind of dealing with, you're going to have still a real big kind of narrative-driven component of the asset class, and this is why a lot of people they buy the high of the Bitcoin chart and they're underwater for 3.5 years. That's happened a few times before in the last 12 years or so.
Mm-hmm.
It's just so intuitive.
Yeah,
it's so intuitive. I mean, like, do people really fly to safety towards Bitcoin? When you think about just like this is the art side of investing, right? Like
within the crypto ecosystem.
with what's that within the crypto ecosystem? Maybe
Within-
yeah. We'll
prior
go to
to
Bitcoin
stablecoin.
versus other.
Yeah,
Yeah.
prior
So,
to
but
stablecoin.
what's interesting is this is the art versus the science, right? You don't have enough data to know what Bitcoin is going to do over many cycles.
Totally.
But if you just intuit, okay, what is like just what does your gut tell you about flight to safety in liquidity events? That's continues to be the U.S. dollar, continues to be sovereign bonds. Maybe there'll be a shift between U dollar not being the flight to safety and treasuries and sovereign bonds, German bunds, Canadian sovereign bonds not being flight to safety. For now, that continues to be the case, right? Bitcoin continues to be a 100-vol strategy that will absolutely make you money in a positive growth shock environment.
And
I'm not so sure it's going to do that on the defensive
I
side.
mean, as Bitcoin evolves over the next 15 years of its life, it may evolve into an actual currency-like
That
instrument.
digital gold that everybody wants to wants
It's
it to
potentially that's what it could do, and it could develop, markets around it. But at the moment, it's not that. I think you have to be open-minded to that. This is one of the reasons I asked about how long do you need, and any new asset class presents some interesting contemplation with respect to that.
Well, didn't a new NFT ETF just launch? What quadrant are we putting that one in?
Oh my God, yeah. That's the kind of stuff you see at the top, though, right? Again, I don't make big market prognostications like, oh, stock market's going to crash. Look at margin debt. I mean, that stuff's a dime a dozen in our industry. But I mean, you want to talk about like bubble activity, like that's the kind of stuff you look for, and that's the kind of stuff that they write chapters in books around, 5-10 years later. And so, if you want to talk about, and I got one last slide to show you guys. I hate, I hate that I dominated the conversation with the slide.
Oh no,
You should, man.
The whole point.
that's why you're here.
By the way, you can end this whenever you want, and you can keep it going as long as you
We'll
want.
wrap. We'll wrap after this.
So this, here we go, slide 78. I'm sure people have seen this chart before because it's part of the bear porn packet. But anyway, so this chart shows the S&P 500 real earnings yield as deflated by the headline CPI, the blue line, and 6 times this has gone negative in the past, 50 plus years.
Sorry, can you describe this? There's a lot happening here.
Sorry, this is the blue line is the S&P 500's earning yield, the real earnings yield deflated by realized headline CPI. So the earnings yield minus headline CPI, the blue line.
Okay. Yeah.
Whenever the earnings yield of the stock market, so it's an inverse way of looking at the price earnings multiple. So whenever the earnings yield, so it's another way of looking at valuation. Whenever the market has been this expensive as a function relative to inflation, relative to inflation, we've seen massive drawdowns. The minimum drawdown is 15% in this backtest. It's a 6 out of 6 backtests, and it's a minimum drawdown of 15%. There's a couple 50%ers in there, or 3 50%ers in there. And so to me, like, this is the all-time low in this real earnings yield. Like this is again,
this is like the 15th like bearish chart I've seen this week.
And so go back to where we started the conversation. Asset markets are very buoyant, risk assets in particular. The Fed is on it's increasingly feels like a train track towards tightening policy, even though we're heading into this.
Yeah.
That's exactly how you get a big market.
Powell did this in 2018 as well, right?
Yeah, exactly.
Well, and it brings up the idea that a lot of these large corrections are caused by policy mistakes, where the misinterpretation of the data creates a situation.
I think they're mostly caused by policy mistakes. I mean, or like guns going off somewhere, but like policy mistakes is it? Yeah, totally. Their framework
hard to model.
Their framework is and now I've had a full glass of wine now.
This is when it starts getting interesting. We all make all the mistakes, and we all.
This is where it gets
designed to have. It is a deliberate policy mistake. Their framework by saying, "Hey, we're only targeting, this kind of maximum inclusive employment shortfall objective, and we're going to actually change our inflation policy as a function or to facilitate getting to that objective," is a deliberate policy mistake. They're effectively trying to ignore impulses in the economy in real time to say we're going to ignore that to get us back to the promised land. That is, some people would argue if you just got a job and you hadn't been able to get a job, that's a policy success. But if you're talking about asset markets, that's probably a policy error because you're going to be behind the curve.
Amazing.
Yeah, I think when I look at when I look at a pure quant model, a pure trend model, and I look at their worst possible drawdowns, that has come at the hands of policy changes that were completely unexpected. Like the 1994 bond massacre had to do with Greenspan completely unexpectedly just raising rates in a manner that we hadn't seen in decades, right? And he didn't project, he didn't explain it to the market, he just went ahead and did it. We saw it again in 2004, we saw it again in 2006, we saw it in 2018 twice when Powell came into power, right? We saw it in January, and then we saw it in August. Like every single time, and then they have to about face within months.
Yeah.
Right? Like
I think that's what's different though about the current Fed, that they've demonstrated a capacity to about face very quickly, and when they do, the policies that they enact are orders of magnitude larger than what the market is prepared for and what we've ever seen before, right? And that trajectory keeps accelerating, right? I mean, they rolled out the same set of tools that they used in the 2008 crisis. It took them 18 months to roll all those out in 2008-09. It took them about, 18 days to roll it out in 2020, right? So this is what I mean by this sort of reflexive nature of this market, right? I mean, you've got a massive amount of speculative fervor, narrative fervor, to your point, Darius. You've got negative dealer gamma across all the major indices at the moment. Like we are primed to be in a critical state. So a minor shock can nudge the market in one direction or another to a much larger magnitude than people are used to. And the government's and the Fed's reaction function is, if you're using the recent past as a guide, a massive unknown in both directions, right? So, these are the reflective dynamics that investors need to navigate here. And I think this makes this market one of the hardest markets to navigate that we've ever seen from a risk management standpoint. So, and what's great about this, Darius, and to Rodrigo's point too, all of us on this call are positioned for dispersion against the common indices at the moment, right? Certainly our portfolios are as well. That's very exciting. I mean, we are going to experience dispersion in one direction or another, right? But that is how you differentiate in this business, and this is how you demonstrate the long-term value that you're going to bring to investors. So, these are pretty exciting times. I really like the framework you've delineated. It's amazing to observe the amount of commonality actually from an ensemble standpoint in terms of like the ensemble of signals that you're using, the humility of using all of them. We don't quite use them all in equal weight, but just, acknowledging the error term in the strength of any one signal to signal the market state that you're in at any given time, and the market positioning that we're beginning to observe in our models and your models. There's a lot of overlap there, and it's exciting. I'm looking forward to some dispersion for a change.
That's awesome.
Darius,
thank you.
Let's let everybody know where they can find you and all that stuff. Let's remind everybody of all of that. Thank you very much for your time. I know that you wanted to keep it a little shorter, but tough break. We wanted to jump into some other stuff.
No, this was outstanding, man. To be able to geek out with some fellow geeks, man, I really appreciate it, man.
Well, we'll be sure to have you back on too.
So of course, definitely. I appreciate it. I'd love to.
But let them know where.
Where can they find you, man?
So I'm at 42macro.com is our website. Come check us out there. I'm on Twitter at 42macro, Dale, DDALE. Pretty active, I guess, to some degree. Thank you, guys. I appreciate it. This was a hell of a discussion. I hope you guys
this is great, Darius. And everybody listening, don't forget to like, to subscribe, to share this podcast. This is one of my personal favorites, I can tell you right now. Follow Darius on Twitter. Follow Adam on Twitter at GestaltU, as in Gestalt University. The whole is greater than the sum of their parts. At GestaltU. Mike, what's yours? Yours is your Mike 99. Mike Philbick 99. I'm Rod Gordillo P at Twitter, and you can find us at investorsall.com. So do follow, and we'll have Darius back. I love this. Maybe once a quarter we can geek out on macro stuff and see what's going on.
Absolutely, man. That'd be cool.
Fantastic. Love it.
There you go, Adam. Mike,
enjoy the weekend.
Yeah, cheers.
All right, guys. See you in a bit.
Most investors feel comfortable with their domestic equity and bond portfolios because they tend to thrive during periods of economic growth and low inflation. And we don't blame you. It's been a great ride. But it's a big world out there, full of opportunities you may be ignoring. Sadly, we live in a world dominated by a fear of missing out, or FOMO. And in the last 10 years, US equities and bonds have outperformed and generated massive amounts of FOMO. This hasn't always been the case. In the mid-2000s, the best performing markets were international equities, especially emerging markets, gold and commodities. So what happens if growth collapses and inflation becomes the new norm? Or what if the US dollar collapses and US assets are no longer attractive? What will the new FOMO markets be? And will your portfolio keep up or be left behind? Enter Rational Resolve Adaptive Asset Allocation Fund, ticker RDMIX, a strategy that is designed to thrive across different markets and economic regimes. Unlike most traditional strategies that keep allocation static and let volatility happen, adaptive asset allocation applies a proprietary systematic process designed to dynamically transition toward thriving asset classes and eliminate those that are not, all the while aiming for consistent volatility and stable returns. There's almost always a bull market somewhere in the world. Don't let yesterday's FOMO get in the way of tomorrow's opportunities. Instead, let adaptive asset allocation help you fill in your domestic portfolio gaps. To learn more, visit rationalmf.com and check out the Rational Resolve Adaptive Asset Allocation Fund.